Welcome to part 3 of chapter 7. In this part, we will talk about some of the most basic cost management concepts and principles. Those basic ideas, concepts, and principles will help you understand better how to do cost estimates of individual activities and how to prepare budgets. Let's start with some very high-level general ideas. You see, most members of an executive board, meaning most managers, most senior leaders within an organization, they better understand and are more interested in financial terms than IT terms. So IT project managers need to be well versed in those financial terms. You see, if you read any textbook on management, corporate governance, you will see that the most important goal of executives, of managers, is maximizing shareholders' wealth. And maximizing shareholders' wealth involves making money every year so that the money that shareholders have invested into a corporation produce return, right? Now, managers and shareholders, they understand that not everything in business or in life in general can be translated into dollar terms. There's those fuzzy, emotional, cognitive aspects of business that can hardly be quantified using dollar values. For example, how do you quantify customer loyalty or customer satisfaction? I mean, it's clear that if you have loyal and satisfied customers, it will somehow will help you be profitable. But how do you attach dollar value to, let's say, the fact that your advertising campaign increased customer loyalty from, I don't know, 75% to 77%, right? How much is that 2% worth? Now, you do know that you spend millions of dollars on this advertising campaign, but the return seems to be not clear. So some things are very fuzzy and you cannot readily attach dollar estimates to those things. But nevertheless, at the end of each year, managers are evaluated on their ability to generate profit. So that's why, executive managers are so focused on cost and the bottom line, and they are much less focused on non-financial considerations such as, network bandwidth or security and all those things. So if you want senior executive managers to be receptive to your ideas as an IT project manager, then you need to translate all those ideas such as system performance, bandwidth, security, storage capacity into bottom line numbers so that they're impressed with the return that your IT assets are providing. So let's start with some basic definitions. Profits are revenues minus expenditures. So this is the most important focus of any manager, to generate profits each year. Profit margin is the ratio of revenues to profits. You see, profits can be large when we talk about absolute dollar value, but when you compare those profits to revenues, they can be very small, to the tune of fraction of a percent, right? So managers, executives, they like high margin, high profit margins, both when it comes to the performance of the overall organization and also when it comes to the performance of individual initiatives or individual projects. Life cycle costing, another idea in cost management, it considers the total cost of ownership, or TCO. That includes development cost plus all subsequent costs related to support for a particular project. So just because it's cheap to purchase a particular software or hardware or an information system does not mean that the system overall will be cheap. I mean, you can use like open source software, but in the long run you'll spend a lot of time making adjustments and hiring people to provide support for this open source software. So free in the long run may translate into substantial amount. So that's why total cost of ownership, meaning the cost of a particular IT asset over its entire lifespan, is used in estimating cost. Cash flow analysis determines the estimated annual costs and benefits for a project and the resulting annual cash flow. Here we have this idea that cash, meaning money sitting in your pocket or being deposited into your bank account, is not the same as accounting profit, because accountants, they use those sophisticated rules to account for activities in this current year and how those activities generate profit. So sometimes an organization can be profitable on paper, meaning it's generating accounting profit, but it's short on cash. They don't have enough actual money to invest into something. So cash flow analysis, it's also very important. Seeing how much cash flow you'll have going in and coming out from your project is very important for persuading managers that your project should be invested in. Here we will talk about different types of cost. the reason we're going to talk about all those types of costs is that IT project managers or managers in general, they don't understand that costs come into a variety in variety of forms, and failure to account for one aspect of cost gives unrealistically low cost estimates of activities. So first, we will talk about tangible costs or benefits. Are those costs or benefits that an organization can easily measure in dollars? So most managers, they're good at understanding those, right? So a tangible cost or benefit is something that can be easily seen or measured. For example, if if your project involved purchasing software licenses amounting to $100,000, that's a tangible cost because you can easily see and measure that cost. You know how much money you spent. Also, if this project resulted in downsizing your accounting workforce by two, you fired, you eliminated two people due to automation, then this is a tangible benefit because you can easily calculate the magnitude of the benefit because the salaries of two accounting employees are now gone, right? So those are tangible costs and benefits. However, there are also intangible costs or benefits. Those are the costs and benefits that are difficult to measure in monetary terms. So let's say your information system improved satisfaction of employees with your IT infrastructure by 5%, right? So what kind of dollar value do you assign to this 5%? I mean, of course, you kind of understand that employee satisfaction will lead to cost savings or additional revenues because satisfied employees, they're less likely to resign, so there will be less turnover cost. Also, satisfied employees are likely to be more productive in their work, but although those things seem to be plausible and realistic, it's not clear how to assign dollar value to those things, right? But nevertheless, intangible costs and benefits, they need to be taken into account as well. Then you have the so-called direct cost. Those are the costs that can be directly related to producing products and services of the project. So buying software, buying hardware, hiring people are direct costs. Indirect costs are costs that you're paying, but they're not directly related to the products or services of the project. But nevertheless, they still need to be included. So indirect costs would be something along the lines of training cost of end users. All those, most of the time it's included as a direct cost, or disruption cost, because when you introduce a new information system, everybody within the organization will have to change his or her work routine, and this creates a lot of disruption and a lot of cost because disrupted employees, they're not productive, they're not generating sales, they're wasting time, wasting money. So those are examples of indirect costs. And then sunk costs, it's the money that has been spent in the past, and this is the kind of money that is spent. You cannot get it back no matter what. And when deciding that what project to invest in or continue, or making any kind of financial decision, you should not include sunk costs in consideration. An example of sunk costs in the field of project management would be something like that. You spend 1 year and let's say $1 million researching a particular technology that you were planning to implement in your organization. And after 1 year, it became clear that this technology is not mature enough. It cannot be used to achieve your goals, right? So that money that you spent on researching the technology is a sunk cost, meaning you spend it, it's gone, you cannot get it back. There's no way to get it back. So instead of thinking, along the lines of a gambler's fallacy, in Las Vegas, when people lose a lot of money, they think that, okay, I lost so much money, I just need to play one more time and there's no way I can lose again, right? So they think that there's a way to somehow recoup or win that money that they lost in the past back. Now, economists would say that if you lost money in a casino, which is, at least in my opinion, a silly thing to do in the first place, why would you gamble knowing that odds are against you, right? To me, it doesn't make any sense. I mean, I know it makes sense from an emotional standpoint. I guess it gives people adrenaline rush, some kind of excitement. It gives them excitement, right? But it doesn't make sense to gamble from a rational perspective. So if you're gambling and you lose money, economists will tell you that the best decision you can make is to walk away. Forget about it. You lost it. You're not getting it back. Instead of saying, "Oh, I can get it back," and going to a pawn shop and using your Rolex, your watch to get additional money to play again, or calling your relatives to borrow some money. So it's a sunk cost. It's gone. The same thing with IT project management. I mean, if you spend $1 million researching a particular software and nothing came out of it, so just leave it alone. I mean, walk away. Don't think that you need to invest. So you don't think that you can. Oh, I will invest additional $1 million and somehow that first $1 million that I invested will come back. If it's clear that things are not working out, you just need to walk away and forget about that money that you lost. You just need to count your losses, learn something from your mistakes, and move on. So sunk cost Money that is gone no matter what should not be taken into account when making financial decisions. So this is like an example of indirect cost. So you may save money developing an information system by using low quality components or hiring cheap development labor. But then if the system is down, it will create all kinds of disruptions across the organizations. So that will, cost you quite a bit of money. So this is like cost of downtime for IT applications. And those costs of downtime, I mean, it can be like direct. Let's say, your system stops working, so you stop trading securities, right? So you don't make any commissions. And also indirect. Now customers have less trust towards your company. They know that you have a system that is unreliable. It can be always down. So some of those customers may desert your company and go to a competitor who is known for having a more reliable IT infrastructure. So this is just like some examples of direct, indirect costs that can be produced by IT. Another principle that is often used in cost management is the so-called learning curve. Now, learning curve theory was, I believe, was noticed by an organization called Boston Consulting Group, or BCG, and it was developed a long time ago. I think it was back around the 1940s or 1950s, and it was actually one of their main tools when Boston Consulting Group, which is number two company after McKinsey, number two management consulting company after McKinsey. So they use this learning curve theory as one of their main consulting tools. It kind of looks fancy, but the basic premise of this theory is that you become good with experience, right? So when you start doing something, let's say developing a particular type of software, it may cost you a lot of money to develop first modules because you don't have much experience, much knowledge in that area. So it will cost you a lot in terms of time and labor expenses. But as you become more experienced, then it will cost you less and less per unit, right? Per module, right? Because now you have a team that understands this area, it has prior experience developing things, so the cost will go down. So sometimes companies use this learning curve theory to estimate costing, to cost activities, to estimate cost with experience in mind. So basically, it will be something along those lines. They're saying that, okay, when we start, this is the cost dimension, this is the time dimension. So they would say something like this: when we start, the cost will be very high because we're new to this, but over time, cost will decrease dramatically. So our cost estimate for this activity will, will not be this one, will not be the high one, will not be the lowest one, but somewhere in the middle. So we're going to use this cost estimate for this particular activity over time, right? So for example, you will, let's say if you're trying to estimate a labor expense associated with a particular software component, then you'll say over time the estimates will decrease, right, because of the learning curve. Another concept in cost management are the so-called reserves. Reserves are dollars included in cost estimates to mitigate cost risk by allowing for future situations that are difficult to predict. So you can have contingency reserves. There are like subtypes of those reserves. There are contingency reserves allow for future situations that may be partially planned for. For example, something along the lines of software bugs. I mean, you may not know what kind of software bugs you will have exactly, but you know that any kind of software will produce some bugs that need to be fixed. And then you have management reserves. They allow for future situations that are unpredictable, right? So you're saying, I'm not sure what it is, but I'm gonna add 10% on the top of my estimates in case something unpredictable, something we cannot think about now, will go wrong. But in any case, any budget should have reserves, because not everything works at 100% capacity. Things go wrong, especially if your project is very complex, involving a lot of technological components, a lot of people. So you need to add reserves, meaning those extra dollars, as a contingency plan to any kind of budget, any kind of estimate. So this completes part 3 of chapter 7. Thank you for watching.